welcome everyone that could make it. I'm Alicia Galloway here from Excite Capital. I am the investor relations specialist presenting our monthly meetup presenter today, which is Scott Maurer. Scott is the vice president of sales over at Advanta IRA, which is a nationwide self-directed IRA administrator. So Scott has been with Advanta since 2006. And he is a frequent speaker and lecturer on topics of all things self-directed IRA and knows our asset class very well, the multifamily real estate asset class. Scott is also an attorney and a member of the Florida Bar. And although he does not give legal advice to Advanta clients, I now know, Scott, that you are a lawyer. So I will call you for legal advice. I did not know that. Right. And just quick funny backstory. I've been working with you, Scott, now for like 5 or 6 years. So I appreciate all your services, and I look forward to you presenting here.
Good. Well, yeah, thanks, Alicia, and thanks to obviously all of you at Excite for having me come on tonight and talk about, which I think probably couldn't time it a heck of a lot better with what's been going on in the market the last couple of days. And you're talking about retirement myths, and kind of the little twist I put on it is really why sticking your 401k in the market probably won't be enough and what you can do about it. I think there's a lot of people right now who are looking at what's been going on the last couple of days with the stock market and saying there's got to be something else I can do, right? There's got to be other alternatives. It can't just be I sit here and sit back and just wait while other people decide what's going to happen to my 401k. There must be a way that I can take action. So we're going to get into that tonight and talk about the different ways that you can really get true diversity within your retirement account using assets like what you can get through Excite Capital. So here's Alicia already read my bio. Here's my contact information if you want to reach out to me after the presentation tonight. If you have questions that you don't want to ask during the presentation for some reason, or if something just pops up later, you want to schedule a time to call, you can certainly reach out to me. There's my number there, or simply reach out to me by email. Happy to schedule time and really talk to you more in depth about your personal situation. The presentation tonight is definitely more of a general overview, but each individual I've noticed over the years, I've been doing this for almost 20 years, always has their unique situation. You might have a unique account type, you might have different concerns than someone else, and doing a one-on-one call makes more sense, or can make the most sense to get down to the issue and get your specific questions answered. So hopefully tonight get some great information that would pique that call. Now just a little bit about Advanta IRA. We are a nationwide self-directed IRA administrator. And for those of you who are not familiar with self-directed IRAs, we are going to spend the next hour or so talking about that and getting more guidance on that. But that's what we do at Advanta IRA, is we administer retirement accounts that we call self-directed IRAs. We have over $3 billion in assets under management. And we really try to set ourselves apart with our customer service experience. So all of our clients get a dedicated account manager. You get one point of contact, anything you need regarding your account. You're not calling the 800 number and getting the next available representative. So it's really how we try to set ourselves apart. And we also believe very strongly in educating clients as well. We do a lot of educational webinars, 1 or 2 a week on different topics. We love coming and being a part of events like this as well when we're invited by someone else to share our knowledge. Now, a couple things that we don't do. We do not provide investment advice, and we do not endorse any products or specific investments. That's something that we're not permitted to do at Advanta IRA. As we talk more and more tonight, you'll see really what a self-directed IRA is and get a better idea of kind of how the accounts work and then what our role is in the process. But we don't sell any products. We're not investment advisors. We're not telling you what you should or shouldn't do. We're simply showing you different alternatives, different things that you could do if you make that decision, to do different things with your retirement account, including investing into real estate, which is what we're here to talk about tonight. If you do need legal advice, tax advice, financial advice, we certainly have outside referrals we can send you to. Alicia mentioned I'm an attorney. I cannot give legal advice. I can't do any legal work for any of our clients. I can certainly talk about legal issues. I can talk about tax issues, but when you need specific advice and guidance in those areas, we simply would refer you to someone else. So question is then, I mentioned we're a self-directed IRA administrator. For those of you who don't know or aren't familiar, what exactly is a self-directed IRA? And kind of just a definition of, it's a unique investment account that allows alternative investments, which can potentially build tax-free or tax-deferred wealth. at a faster pace possibly than traditional methods. So it's a way that you can use your retirement account to invest in other types of assets outside of the stock market. I mentioned at the very beginning when I started talking that there's a lot of turmoil right now in the stock market. That's something that pops up from time to time. The market was going along just fine and doing just fine, and then boom, bump in the road. Now the market's lost some significant value in the last few days. People start looking for what other assets are out there. What other things can I do besides simply investing into the stock market? And the self-directed IRA gives you the ability to keep your funds tax protected inside the IRA, but ultimately invest in different kinds of assets. So it gives you more control over the funds themselves, over the investment decisions. And these assets typically that we hold at self-directed IRAs are outside of the stock market. So we're not a broker dealer at Advanta. We are clients using our services do not typically invest in mutual funds or stocks or bonds. They have their own Fidelity or Vanguard accounts where they make those investments. But through Advanta IRA and through their self-directed IRA, they are investing in things that are considered to be, like I said, alternative assets. You'll hear me say that a lot tonight. Alternative assets, alternative investments. Again, things there where their common thread is that they're typically not available on the conventional platforms like Fidelity and Vanguard offer. These assets, again, are not publicly traded. So stock market fluctuations and valuations maybe don't have nearly as much impact on the returns that you're going to get from those different types of investments. So one of the common things I've seen over the years is that the clients I talk with, the individuals who are looking to utilize our services, who have money in IRAs, who have money in old 401ks, why do they choose to self-direct a part of their portfolio? Why do they choose to take some of their money out of the stock market and put it into real estate investments or gold and silver and the different things that you can do with a self-directed IRA? I think over time, I've just noticed that most people fall into one of these three buckets, if not more. For some individuals, there's tax benefits from using your IRA to invest. If you invest and reinvest inside your IRA account and you're getting rents, you're getting dividends, those typically come back to the IRA, either tax deferred or tax free back into the account. So for instance, a few years ago, we had a number of individuals investing in a private insurance company startup that they expected the stock, once the company went public, would do quite well and have some significant gains. So they made the investments in that stock using their IRA, their Roth IRA account. So there's no tax gain to them when the stock did go public and they did make a nice profit on their investments. Now, there is one unique area where an IRA can be subject to tax, and we'll talk about that a little bit later in the evening. For most people, though, it's one of these other two reasons. Either for some, when they're looking to make an investment and they're looking to see where the cash is that they have that's available to them, find out that they could use their IRA account, and so their IRA account becomes simply the source of capital they use for an investment opportunity. So you take the example of individuals investing with Excite. Excite presents a deal. It looks good. The numbers look good. This is a great investment opportunity. I would like to take part in it, but I don't have any personal savings account that I want to use or not money that I want to touch. What other cash could I use to do that? And for those individuals, it's simply, hey, I have money in my IRA. I have money in my old 401k account. I can make this investment into this investment with Excite. Or maybe you've done investments in the past into real estate. You're looking to just simply acquire more, and the IRA, the 401k provides a new source of that capital. But again, the other common reason, we're seeing it a lot, obviously, in the last few days, is simply the stock market fatigue. The ups and downs, the uncertainty in the market, more than anything, of just not really sure what you can count on, what stocks to pick, what mutual funds to pick. Self-directed IRAs gives you the ability to choose your investment, whether it's real estate or other assets that we'll talk about tonight, and get your money out of that stock market and that roller coaster that it's on. Now, common question we get up front is, why haven't I heard about this before? Right, when we're talking with a new investor who has money in an IRA, has 401k, they get introduced to us by people like Alicia and the folks at Excite. Why haven't I heard about this before? And it's simply because most IRAs, most 401k accounts are held with banks and brokerage firms who offer you only those products that they sell. right? They offer you mutual funds, stocks, whatever's available on their platform, and you're required to only invest in things that are on their platform. But IRS regulations allow you to invest in a much broader range of different investments that are out there. The caveat, the caveat to that is not every custodian is required to hold every investment. So Fidelity and Vanguard could hold real estate investments on their platform if they chose to, but they were more in the business of selling mutual funds and stocks, so they don't make that available to their clients. But the IRS regulations do allow you to make the investments, and that's why our company and companies like ours exist, right? Because we exist to hold these alternative assets. People who have money in an IRA, have money in an old 401k, see a unique investment opportunity, want to make it with that money. They don't want to pull the money out and pay taxes on it. So they simply move their IRA account over from a Fidelity or Vanguard to a self-directed IRA and then turn make that particular investment. So again, simply not well known because the banks and brokerage firms have no interest in telling you that these other options are possible. They would lose your business. You take the money elsewhere. So what are some of the common assets? I would say probably 70 to 75% of the assets that we hold at Advanta IRA on behalf of our clients are real estate in nature. It's people who own single family homes, whether if they're holding them for rental purposes or maybe they're rehabbing them. People invest in mobile home parks. They invest in tax deeds and tax liens, joint ventures, partnerships, and as we're kind of talking a little about tonight, investing in syndications or private placements where it's a much larger project that one individual cannot invest in on their own, but they can work with a number of other people to make that particular investment. So the syndications in the private placement space is something we've seen grow significantly probably over the last 5 or 6 years for people looking to use their IRA to take advantage of those opportunities. Other alternative assets that you can hold in your IRA, you can hold LLC interests, mortgages, notes, movie projects, precious metals, foreign currency, cryptocurrency. The list really goes on and on. We're going to talk about in a few minutes the restrictions that are on IRAs. So the IRS does not publish a list of all of the possible investments you can make inside of an IRA account. They simply list the different things that you cannot do with your retirement funds. So take a step back just for a moment, talk about the different types of accounts that an individual can self-direct. I think that's important to know when we're talking about self-directed IRAs tonight, which kinds of money, which kind of accounts are we talking about that can be accessed. We offered Advanta IRA, and you can self-direct any type of individual IRA account, like a traditional IRA, a Roth IRA, or if you inherit an IRA from someone else, those plans can certainly be used. If you're a small business owner, if you're in business for yourself or you're self-employed, you don't have any employees, you could have a solo 401k plan. You may be able to start either a SEP or a simple IRA for your business. And some of the differences between these plans and the traditional or Roth IRA is that you can contribute quite a bit more in a given year to a plan if you own your own business. If you're doing a solo K, a SEP IRA, or a simple IRA, you get a larger contribution limit on an annual basis. We'll talk a little bit more about the solo 401ks a little bit later too. One of the other important differences they have compared to IRA accounts. But again, any type of IRA can be self-directed, traditional Roth, SEP, or simple, and any type of former employer plans is the other big area that I think people miss from time to time, are people who have old 401ks, old 403bs, TSP plans, where they worked for an employer for a number of years. They left that employer for whatever reason. They were retired, maybe they quit, took another job, they were laid off. Once it becomes a former employer's plan, you can take that money and roll it to an IRA account and in turn enroll it to a self-directed IRA to be able to access those funds for different investments. Again, I mentioned that those plans are forgotten about quite a bit, because a lot of individuals, when you leave a job, you taking a new job, you kind of, that's low priority, right? Is what's happening with your old retirement account. You're more focused on starting a new job, getting into your new role. Maybe you've changed cities where you're living and you're moving. A lot of other things take precedence, and a lot of people forget sometimes that they have those old 401ks, those old 403b type plans that they can use. So any type of former plan, Any type of existing IRA can be self-directed. The only restriction a lot of times is you cannot use current employer plans. If you're currently employed with a company, they may limit your ability to move the money while you are still employed there. So with any IRA that can be used, the way to get that money transferred to a self-directed IRA is by doing a transfer, basically an IRA to trustee transfer, which is what limits you and causes you not to have any tax liability whatsoever. And this is a part, I think, of the equation that a lot of advisors miss, and a lot of CPAs I've even seen miss from time to time when you talk to them. If you're saying, hey, I have money in this IRA at Fidelity, I'd like to invest in this upcoming syndication investment and move some of that money from Fidelity to make that investment. A lot of advisors, because they're not aware of what self-directed IRAs are, and the ability to invest the IRA itself into these types of syndications and other real estate investments, they typically think that you're having to pull the money out of the IRA and actually take it out as a distribution, which is a taxable event and potentially have penalties as well if you were to simply withdraw money from your IRA account on an individual basis. So a lot of individuals don't realize, these advisors, these CPAs, they tell their clients, oh, you're looking at 20 or 30% in taxes to make that investment. What they're missing is that when you're choosing to self-direct your IRA and invest into alternative assets like real estate, is that you're not taking the money out personally as a distribution. You're simply transferring it from your current IRA into an IRA account where you're going to have these different available investment options. So doing a trustee to trustee transfer from a Vanguard Roth IRA to an Advanta Roth, or from a Fidelity traditional IRA to an Advanta traditional IRA, is a non-taxable, non-reportable event. We request the funds, you complete a form, you sign it, we send that form to your other custodian to have that money directly transferred. Again, money does not touch your hands. It's a non-reportable, non-taxable event. And you can do transfers between IRA custodians as often and whenever you'd like. So that means, I think importantly, when we talk about looking at self-directing as well, is that you can move over just what you need to make a particular investment. So if you're looking at doing a $50,000 investment into a syndication, you can transfer over just the $50,000 you need for that particular investment. There is no requirement that you move the entire account. So you can do multiple transfers, again, as long as the funds never touch your hands, is a non-taxable, non-reportable event. So transfers are IRA to IRA. Direct rollovers are when you move money from an old employer's plan into an IRA, again, also with no tax consequence to you. So if you have that old 401k, you have an old 403b plan, you reach out to the administrator, you ask them, say, hey, I just set up an IRA with another firm. I would like you to send funds, send my 401k funds over to this new self-directed IRA account. Again, the funds will go directly from your old 401k into the IRA account with no tax consequence to you. Again, you are not taking any personal possession of those funds. So again, transfers and direct rollovers are how you move money from your existing account into a self-directed IRA, again, with no tax consequence. Again, I've seen countless advisors. I had a call earlier today with a potential client whose advisor had said you're looking at 40% in tax as what they were thinking about doing. And I had to tell that client, you're not looking at any tax because you're simply transferring this money inside from one IRA to another. You are not taking the money out on an individual basis. So again, that's a very important part of the process, that when you use a self-directed IRA to invest in real estate and invest in these alternative assets, you are using the IRA account as its own legal entity to make these investments. It's not you pulling the money out personally and paying taxes on a distribution. You are using those funds inside of the account to make the actual investment. So let's talk a little bit about the rules. I mentioned a few minutes ago that when IRS does not maintain a list of all of the possible investments you can hold inside of an IRA account. In fact, they created IRAs back in 1975. They set the rules in place then and have made actually very few changes over the years to what's allowed or not permitted within the IRA accounts. So back in 1975, when they were saying what they didn't want to make a list of all the things that could be potentially an investment, they would have probably not foreseen cryptocurrency as an investment inside of an IRA account. But again, when IRAs were created in 1975, they simply said, here are the things that you cannot invest in with your IRA account. These are the things that the rules we're going to put in place. And the only two prohibited investment classes are you cannot invest in life insurance and you cannot invest in something deemed to be a collectible, like antiques, artwork, alcohol, collectible stamps and coins. There are some coins, gold and silver American Eagles and bullion. Those are permitted because the value of those coins is based on the metal. It is not considered a collectible at that point. So again, the IRS said no life insurance, no collectibles. There's nowhere in the code that it says you can invest in real estate or that you can invest in stocks or that you can invest in bonds. It simply says you cannot invest in life insurance and you cannot invest in collectibles using your retirement account. The other area that they restricted is if you are looking at buying a permitted asset. So you were looking at investing in real estate, you're looking at investing in stocks. That transaction between your IRA as its own entity cannot involve a disqualified person. So your IRA cannot transact with a disqualified person. Your IRA, the IRA owner or disqualified person cannot receive any benefit from the investments made inside the IRA. What that means for practical purposes is, for instance, if you're investing into real estate, you as the IRA owner cannot live in the property. No disqualified person can live in that particular property. If you're lending money from your IRA, you cannot lend money from your IRA to any disqualified person. So depending on what type of an investment you're getting into, the prohibited transaction rules will focus more on who else might be involved in that transaction. But if you're looking at investing as an LP in other people's syndications, you're looking at lending money to third parties, you're looking at buying rental properties that you're going to put on Airbnb and you're never going to use, then these rules typically don't have any impact on what you're looking to do. So there are prohibited investments, life insurance and collectibles. There are prohibited transactions with disqualified persons. Then there's another little known tax, and this is not something that makes your IRA prohibited, doesn't make it something you can't do within your IRA, but it's something to just be aware of. There's a little known tax called unrelated business income tax, or UBIT, which can apply to an IRA account if an IRA is in receipt of business income, if any business income is generated by the retirement accounts. If your IRA invests into a restaurant and every month you get a percentage of the profits from the restaurant take, your IRA can be subject to this UBIT tax, unrelated business income tax. Any passive income like rents and dividends, interest, that's passive income, that is not subject to UBIT. Now, the other area where a tax can apply, and this definitely comes up in the real estate realm, is if your IRA is involved in buying real estate, where your IRA is financing the purchase, or your IRA is involved in a leveraged asset itself. So your IRA has invested possibly into a syndication where there is underlying debt. Your IRA can be subject to this UBIT tax. I'm going to talk a little bit more about this as we get to the case study and talking about a syndication and how UBIT applies, and give even a kind of a little mini calculation of how it works. But just note that on this slide, we have prohibited investments and prohibited transactions, things that you cannot do within an IRA. UBIT tax is not against the rules. It does not violate anything with your IRA account. It's just a tax you need to be aware of depending on what type of an investment you're making in the account. Just very quickly, we were talking about disqualified persons, and one question obviously is, who are the disqualified persons from your IRA? These are the people that cannot transact with your IRA. They cannot benefit from investments held inside the IRA, and the disqualified persons typically include, or they do include, you as the IRA owner, right here in the middle of the slide, on the right-hand side, your spouse, then your parents and grandparents, and then going down, your kids and grandkids and spouses of those individuals as well are considered disqualified persons. So these individuals cannot receive any benefit from the IRA, so they would not be able to live in any property owned by the IRA. You could not lend money from your IRA to any of these individuals. And it does also include any business or entity that is owned or controlled by one of these individuals as well. So if you wanted to lend money to your son, but it's prohibited. You can't get around that by simply lending it to his LLC. That would be prohibited also. Now, not considered disqualified, brothers and sisters, aunts, uncles, and cousins, other friends, relatives, colleagues. If they're not on this list, they are not considered a disqualified person. So we've had many situations where brothers or sisters have invested with their other sibling using their IRA account, and that does not violate the IRS rules. So before we get into a couple of the case studies, and again, if anyone's listening and has questions, make sure you type those into the question box. I'll get to those and get those answered for you tonight. But I think when you look at investing, and maybe more specifically talk about real estate investing, I think a lot of investors see themselves in one of two ways. You have people who are active, who probably are looking more at buying rental properties that they're going to oversee or manage, or they're buying a rehab so they'll manage that project itself and get your contractors in line and hire people out to do that work. Where those individuals want to be more in control. They want to have more decisions, be more hands-on with what's going on. But that's going to eat up more of their time and energy, the expense. They're now responsible for all the details. But again, for people on the active side, that's usually what they enjoy, and those are the typical investments that you see them do. Now, you have other passive investors, though, people who tend to invest more in private placements or syndications or do private lending, where there's not as much time commitment. There's certainly some evaluation up front of the investment, doing the due diligence, being comfortable with the investment itself. But then once it's set in place, other people are managing the project. Now, real estate syndication is a perfect example of a passive investment where you evaluate the opportunity up front, you review the prospectus, you do your due diligence, you see the property, you talk to the operators. But once you make the investment, it's up to the GPs in the deal, the operators, to actually run that project and return any profits back to the individual investors themselves. So again, I think when you're trying to look and see what you're looking at investing in, if you're looking at self-directed IRAs, again, you're upset by what's going on in the market or what's been going over in the market for years, where it's ups and downs, and you're looking for other types of investments. I think this is a good exercise to go through. Is really what type of investor do you see yourself as? Somebody who needs to be more in control? Then you're probably looking at investing more in a rental property or a rehab where you're doing that, or you're doing more an active lending. Or you're somebody who's more passive, who you want to diversify, you want to be involved, but you don't either have the expertise or maybe the time involved to actually be kind of in charge, but you're happy to invest with other people as well. Looks like we did have a question. Somebody came and asked, is the process involved with a lot of documentation, or it's straightforward? So I will get to that here. We're going to go through a couple of case studies. And Alicia, I don't know if you're still there. Did I lose my screen, or can y'all still see the screen?
Yep, I'm still here, and I can still see your screen. It's the type.
Oh, there we go. Okay, good. Okay. Yeah, just a question was asked about the documentation. We're going to get to that in just a minute in one of the case studies. So we'll talk about that. So if you're looking at investing, I think when you're talking about, especially if you're looking at an investment itself, again, whether it's a syndication through Excite or just a different investment opportunity that comes along, the pros and cons, if you're looking at investing through your IRA or an old 401k or using your personal funds. Now, if you're an IRA or 401k, any of the income that's being generated from that investment is not taxable to you, right? That's all money just going back into your IRA account. You're going through the dividends, the profits on sale, whatnot. You're not locking up your personal savings or emergency funds, I think, which is a big reason why people choose to use their IRA when presented with these opportunities. If they have savings accounts, they have emergency funds, they don't want to lock that into something that's a 3 to 5 year investment, or something that's not easily liquidated if they need it for an emergency. With the IRA or 401k, though, you lose the tax write-offs. You don't get that income personally. It goes back to the IRA account itself, and you typically cannot be involved personally in the management of the asset and getting compensated for doing so. If you're investing personally, you're getting cash flow now. You can act in that managerial capacity. You can get compensated for doing that type of role. You use the write-offs and depreciation, etc. But you are going to be taxed on the income personally. you're going to have that money tied up into a different investment. But I think the biggest thing to take away from this slide is the very last point on the right-hand side is that if you do have an IRA or 401k and you have personal funds and you're looking at a different investment, even if you choose to invest personally, that IRA, that 401k money still needs to be invested somewhere to be earning you a return. You can't have it sitting in the market necessarily going up and down. You can't have it just in a low interest CD and writing it out for time. That's not a good long-term play. So if you do need to get that money working for you, what is going to be the best investment option? What are some of the different ways you could diversify and earn more within that IRA, within that 401k plan? So let's go through a couple of case studies. The first one we're going to talk about funding a loan, doing a private loan from your IRA, funding a rehab project where we have Bill and Stephanie. Bill bought a house to flip, needs the cash from a private investor to fund the rehab portion of the deal itself. Bill and Stephanie, they've known each other for years, grew up together, went to school together. And Bill tells Stephanie, hey, here's my deal. I have this property. I just bought it. I need $50,000 or so to get this property rehabbed, get it sold, make a nice little profit on it. And I'm happy to share some of that profit with you if you're willing to lend me the money. And in talking with Stephanie, Bill tells her, hey, if you have an old 401k fund, you can use that money to fund this particular loan and have all of the gains, all of the profits simply go back to your IRA, back to that old 401k account with no tax consequence to you whatsoever, and helping to grow that retirement account. Stephanie says, hey, that money's just been sitting there, haven't been doing much with it. So she agrees to loan him the funds for the rehab. And the loan terms will be between Stephanie and Bill. So whatever the interest rate, profit split, whatever collateral is involved, that's going to be between Bill and Stephanie to negotiate. Advanta IRA does not get involved in that part of the process. It'll be up to the two of them to figure out what that looks like. Where we do get involved. So Stephanie, if she's looking at getting this started, will have to fill out paperwork with us to open up an account. It takes 10 or 15 minutes to fill out our documents, to get the account opened, name her beneficiaries, and then work on getting the funds rolled over from her old 401k accounts. That's getting the account opened and funded. Usually takes somewhere between a week and 2 weeks, depending on your other custodian and where the money's coming from. At that point, Stephanie has her account open and says, hey, Advanta, I need to lend money to Bill. It's going to be a loan. There's going to be a mortgage attached to it. Our job at Advanta IRA will be to review all of that investment paperwork. So Bill's going to have his attorney, maybe Stephanie will have her attorney draft the paperwork up for the actual loan that Bill's going to sign. We ask that they give us those investment documents a few days before funding so that we can make sure that the proper wording gets placed on the document. As you'll see in our next case study as well, one of the most important things we do at Advanta for our clients is making sure that any investment gets titled in the name of their IRA account. So in this particular case, it's going to be Advanta IRA, FBO, or for benefit of Stephanie S's IRA and her account number. This demonstrates to the IRS that this is an investment in her IRA. So when we send money out of her account to fund this loan, it is not a distribution. It is the IRA making an investment in a private loan. So that all of the proceeds, the interest that Bill's going to pay, or the profit share that Stephanie's going to get when the property sells, that is all going to come back to her IRA account with no tax consequences to her. That's, again, the important thing about this part of the transaction is making sure that proper wording is on there. We're going to make sure before we send money out of her account, again, that the documents are titled, and also make sure, in this case, that Stephanie reviews and approves all the paperwork for us before we send funds out of the account. So you can see the note itself on the right-hand side. Bill's attorney prepares the note and mortgage. We are going to send those documents to Stephanie to review, initial off her approval. Ultimately, when she has approved the documents, we will send the cash from her IRA to the closing agent, to Bill's attorney, to finalize that investment. So the $50,000 loan leaves her IRA, goes to Bill's attorney. He uses it on the rehab. That completes the initial part of their transaction. You can see the loan terms. This particular client that we had $50,000. She did a 5% interest, so a really low interest rate, but she got back 25% of the profit. So whenever he sold the property, any profits he made, 25% of that was coming back into her account. Fast forward 6 months, Bill sells the property. It's going to net $40,000 in profit. So 10,000 of that is going to come back to Stephanie's IRA account. So she makes a nice little profit on her funds. And again, the earnings are all going to be tax deferred back to her account. So if we look at the final values on the screen, see that's coming, didn't switch yet. Oh, there we go. She got her repaid principal. She had some monthly payments during that 6 months, and she got a percentage of the profit. So a nice little gain back to her IRA account for doing a private loan. And from Bill's side of the equation, he borrowed her money, and even after paying her loan payments, paying the loan itself, he still had a nice little profit for himself. He didn't have to go to a bank, didn't have to go to any other type of hard money lender. He just used a friend who had an IRA account to make it happen. All right, our next case study is investing in multifamily. Again, a lot of people on this call are familiar probably with this type of an investment. So let's go through it on how it works when you're looking to make this type of an investment using your IRA account. So we have Jane and John. John has over $100,000 in his Roth IRA account at Vanguard, and he meets Jane. Jane has the apartment complex they're looking to purchase, looking to remodel it. Again, she has a prospectus drafted up. She has subscription documents that she got from her securities attorney and sends all of that over to John for his review. Again, very important with Advanta IRA, we are not reviewing the prospectus to make sure that this is a suitable investment for John. This is something that's up to John with a self-directed IRA to be comfortable with this investment itself, whatever money he wants to invest. And he looks through all the pro formas, looks through all of the data, and decides, yes, I would like to make this particular investment using my Roth IRA account. So John, again, same as Stephanie in the last example, his first step is to open up his Advanta Roth account. Again, filling out our paperwork takes 10 or 15 minutes to do, where he's giving us his information, naming his beneficiaries, and then saying, hey, I have an account at Vanguard. I'd like to transfer $100,000 from that account, from a Roth IRA there to the Advanta IRA Roth. Again, a non-taxable, non-reportable event. Again, probably would take a week or so to get these funds transferred and to get that account set up and ready to rock. So we send that transfer form to Vanguard, and we will notify John when the funds arrive. But while we are waiting for the money to arrive, like we did in the last transaction with Bill and Stephanie, it's very important for us that the paperwork is going to show John's IRA account as the actual subscriber. So his account manager here at Advanta IRA will work with him. He'll work with the investment provider to get those subscription documents completed properly in the name of the IRA. Again, this is very important from an IRS perspective, that this now is becoming an investment inside of his Roth IRA. So the actual subscriber is Advanta IRA, again, for benefit of John Smith's IRA. The tax ID number that is used on these subscription documents will be Advanta IRA's trust tax ID, not John's social. We want all tax reporting coming back to his IRA, not to him as an individual. We will send all the subscription documents to John for his approval, and once he indicates that, yes, I've read through this, I would like to proceed with the investment, we will send a wire of the funds to the actual syndication to finalize the purchase. Going forward, the future dividends and profits are coming back into John's IRA. The account gains that he's getting are not included at all in his income. We're going to talk about that UBIT tax here in just a moment. But when John's IRA exits the investment, all the proceeds go back to his IRA, again, with no tax consequence to him as an individual. Okay, because it's not John as an individual making this investment. It is his IRA account. So any tax ramifications from this type of investment all go back to John's Roth IRA account. So because he's investing into the syndication, and the syndication is leveraged, John's IRA is going to be subject to the UBIT tax I talked about a few minutes ago, the unrelated business income tax. How this tax works, and I have an example on the next slide that goes to a little mini calculation, is that if the real estate investment is leveraged, then a portion of the return that is relative to the percent of the overall leverage is subject to this UBIT tax. So if the project is, say, 70% leveraged, then 70% of the income back to the IRA will be subject to this tax. So if John gets $10,000 of returns in a given year on his $100,000 investment, 7,000 will be subject to the UBIT tax. The other 3,000 goes right back into his Roth, no tax consequence whatsoever. Just a couple notes on UBIT as well. Interest income is exempt from UBIT. There are some individuals who have set up C corporation. It's called a blocker corporation, where you can pay tax at the corporate rate of 21% rather than paying the potential 37% UBIT, which is the highest rate if you have a significant amount of income. But again, even if UBIT's going to apply, is the rate of return you're getting still better than maybe what you're getting in the conventional market is something else to consider. And I'll show you on the next slide how UBIT tax doesn't have as much bite as a lot of people think it does when it comes to your overall return. So if your Roth IRA or if your traditional IRA is subject to UBIT, your IRA would file Form 990T and deduct a percentage of the expenses. You can take the cost segregation, accelerated depreciation to limit or potentially eliminate UBIT tax altogether, at least in the first year or two of that particular syndication. There's no UBIT tax due. There should be no tax return filed as well. The UBIT tax is paid at trust tax rates that do top out at 37%. Again, as you get to more and more income coming back into the IRA, it certainly doesn't start at that level. But again, this is a tax that if the UBIT tax applies, this tax is paid by the IRA itself. It does not show up on your individual tax return. And it's something that's very important. This is not a tax that you have to account for, that you have to pay on your 1040. It's if the tax is due, if there's any, or if the tax applies, and if there's any tax due, your IRA would file this form, and any taxes that would be due come out of simply the IRA account. You can also carry forward losses. So if you do have a lot of accelerated depreciation in a given year, you can file the 990T to carry that loss into future years as well. Now, one important note, and I mentioned solo 401ks as a different account type. When we were talking about the different accounts, we had the traditional and the Roth IRAs. You have your SEP and your simple IRA accounts. But for those who are self-employed, if you own your own business or you work for yourself, or even if you have a side gig that you work, you could set up a solo 401k plan, and solo 401k plans do not pay UBIT tax on leveraged income. So if you meet that category where you are self-employed, or you have your own business, or you have a side business, you could set up a solo 401k and just eliminate these calculations altogether. So here's an example of what the calculations look like. I'll kind of walk you through it slowly. It's a $100,000 investment. It's getting an 8% return year over year. So in year one, $8,000 comes back to the IRA. Now the property is 70% leveraged in year one. That's the initial acquisition. So only $5,600 of that return of that income is even going to be subject to the UBIT tax. You get an automatic deduction of $1,000 from the IRS for UBIT. The other deductions, the accelerated depreciation, those all exceed $5,600 in that particular year, which means your taxable income first year to the IRA account is zero. So there's no UBIT tax due whatsoever in year one. Year two, $8,000 of income comes in again, but now there's only $4,800 is subject to UBIT because the property has grown in value. So the debt to the leverage ratio is much less, or the leverage has also been paid down a little bit. So only $4,800 is even subject to UBIT. You still get that $1,000 deduction. You get another $1,000 still of other deductions from your that you cost seg or just other write-offs that you get as an investor. So only $2,800 is subject to UBIT tax, and at 24%, your IRA is paying a whopping $672 of tax on that income that it got that year. So the rest of it, again, returning right back into the Roth account. So in year three, we have the $8,000 of interest, plus there was an additional $20,000 gain when the property sold. So because at the time year 3 came, again, the property was selling, the property had increased greatly in value, there wasn't as much debt. Only 50% of that 28,000 is even subject to the UBIT tax. You get your deductions. The taxable income is only 12,000 out of the 28,000 total that you got. So you're paying $4,200 in UBIT tax that particular year. So a little bit higher rate, certainly nothing great. You prefer you didn't have it. But at the end of the day, the important number to look at is the totals on the right-hand side. If you had a $100,000 investment in 3 years, even after paying UBIT tax, your total investor return on your $100,000 investment was still $39,128 in this calculation. So you're still getting a pretty hefty return on your money over the course of that time. So again, UBIT tax, I wish it didn't apply. I wish it wasn't there, but it's not as bad as some people want to make it out to be at times. And again, if you do have a solo 401k or you can qualify for one, this calculation, this slide doesn't mean anything at all because the UBIT tax would not apply to that solo 401k plan. So getting started, again, is easy. It's a matter of filling out paperwork to get an account opened. It takes 10 or 15 minutes to get the account documents completed. We get the account open. We need to do the work on the transfer or the rollover from your other IRA or from your other 401k account. Again, that funding can take anywhere from a few days to sometimes a few weeks, just depending on where that money is originating from. And then ultimately, you tell us what it is that you want to invest in. Most of our clients, by the time they get to us, they're already on step 3. They found the investment. They know what they want to invest in. It's our job to help them then go through steps 1 and 2 and ultimately make the investment inside of their IRA account itself. So again, our job at Advanta is to manage this entire process, to act as a custodian. Again, getting back to the very beginning, because Schwab, Fidelity, Vanguard, Morgan Stanley, those companies choose not to hold these types of assets on their on their platform. It's not because you can't. The IRS rules are very clear that you are allowed to invest in alternative assets. You just have to have a custodian who's willing to hold it. And that's what we do at Advanta IRA, whether it's, again, a syndication, a rental property, the gold and silver, the cryptocurrency. We can hold all of those types of investments inside of your IRA and maintaining the tax status of that account, which again, that's where advisors and CPAs get lost, is they feel you have to take that money out of the account and pay taxes on it, which is simply not true. That's what they're just not familiar with self-directed IRAs and what our firm and firms like us do. So I just certainly would encourage you, if you have questions, get those in the box. I think we have a couple that have come up since we were talking. Again, one of the first questions was, does this process involve a lot of documentation? Or it's straightforward? The answer is yes, I guess, to that. It does involve a lot of documentation. It's not the same as if you have a brokerage account where you can pick stocks and mutual funds and you simply click on, buy this many shares and you're done. When you're investing into a syndication, there are subscription documents that need to be completed in the name of your IRA account. But it is very straightforward. It's a process that we've been doing for almost 20 years. We know exactly what needs to be completed. We utilize DocuSign to make it very easy for you to explain exactly what steps are going to need to be taken, what you need to do, what we will do on behalf of the IRA account. So it is a straightforward process. It's just going to take a little bit longer than buying a stock or mutual fund through your online platform. So we manage that process, and we work with great people like Alicia at Excite as well, who helps make that documentation and process much easier as well. Really good question. What contribution limits for IRAs in 2025, and are there penalties for exceeding those? Good question. So with IRAs in 2025, the contribution limits are $7,000 a year for traditional and Roths. If you are over the age of 50, that amount is $8,000 for 2025. For SEP IRAs and for solo 401ks, I believe the limit is $70,000 this year. So up to $70,000 if you're self-employed and can do a SEP or a solo 401k. Those are the limits for 2025. They do index every year for inflation, so they continue to creep up year over year. And there are indeed penalties for exceeding those limits. If you over contribute to your IRA account, the IRS will assess a 6% penalty for the amount that you leave in the account. If you don't pull the money out, you'll be charged the 6% penalty for leaving that money inside of your IRA as an over contribution. Now, one thing that's important to note when we talk about contribution limits of that 7 or 8,000 is that's only money out of your own pocket that you're putting into the plan and you're putting into the IRA account in a given year. That last case study we were showing where John's IRA is getting $8,000 a year, that is earnings in his account. Earnings are not subject to any type of contribution limits. So if you were to buy a property to rehab, for example, and you flip it and make $50,000 in profit, that is not any part of your contribution limit. That is earnings to your IRA, and again, earnings to an IRA are indeed unlimited in a given year. All right, so next question, do you have to be accredited to use your IRA? And the answer is it depends. So if you have, it depends on the investment that you're making with your IRA account. If you're investing in, say, just a regular rental property down the street, or in the first case study, you would like to make a loan from your IRA to somebody who's rehabbing a house, there's no accreditation status needed. Now, when you're looking to invest in the syndications and private placements and things of that nature, those investments a lot of times do have their own accreditation requirements. That's on a per deal basis. You have to look and see what their status is, what their requirements are. If I sell a property owned by my IRA, can I reinvest the profits into another property without tax consequences? Absolutely. A lot of people are familiar with 1031 exchanges that are outside of an IRA. If you own property personally and you sell it, you can reinvest the profits via 1031 exchange, so you don't have any tax consequence. IRAs are their own 1031 exchange inside themselves. So your IRA could certainly buy an asset, make a profit, sell it. That money comes right back into the IRA, and you could use that cash to simply invest right into the next deal that you have. Again, with no tax consequences at all. That's how IRAs work. It's the same principle involved, and a lot of people get confused when you talk about real estate in this nature with an IRA because it's not something you're accustomed to seeing. But if you had an IRA invested into stocks and mutual funds, and your stock, you bought a stock and it doubled in value and you sold it, you wouldn't expect to have any tax consequences there, and you'd expect to be able to use that money also. So it's the same principle involved. Another question, do all the proceeds made from the IRA have to go back to the account, or can I take some? So initially, if your IRA has an investment, the proceeds all do have to go back initially to the IRA account, as the IRA is the investor. If you wish to then take some of that money out as a distribution, you can certainly do so. We have many clients who receive monthly interest payments or monthly profit payments back into their IRA account, and they then have a distribution form on file that we simply take that money and send that money to them as a distribution. If you take money out of the IRA, though, you're subject to the same distribution rules for all IRA accounts, which typically you have to be over 59.5 to take the money out without any 10% penalty. So yes, you can certainly, the money has to go back to the IRA, but you can then take it as a distribution after the fact. How much does it cost to set up this type of an account? We charge our fees, our flat administrative and custodial and record keeping fees. We charge a $50 one-time fee to open the account. There's a one-time $95 transaction fee to do and review all the paperwork. So the two case studies we went over, there'd be a $95 fee from us to make sure all the paperwork gets properly titled and make sure the client reviews and approves the documents as well. And on an annual basis, we charge a flat $295 a year to then hold that investment. So for $295 a year, we receive and deposit all the payments back into the account. We take care of all the IRS reporting. If there's any expenses to be paid out of the IRA, we pay those out of the account as well. So it's a $50 and a $95 one-time setup fee and startup fee, and then the $295 is our annual fee that we charge to hold each asset in the account. If I use my Roth IRA, do I still pay the tax? So I think if you're talking about UBIT tax, yes, your Roth IRA is still subject to UBIT. But if you're not talking about, once you're looking to take money out of a Roth IRA, once you're pulling out money personally, there's no tax income due to you. But if you're talking about a Roth IRA investing into a syndication, like that last example we had with John, he was using a Roth account, his Roth would be subject to UBIT tax. Now, once you get done with the UBIT tax, anything he pulls out from that standpoint after the fact would be not taxable income to John. That's a different. The Roth IRA is a different IRA than the rest of the traditional and the SEPs and the old 401ks, where you do pay taxes when you pull the money out personally. With a Roth IRA, when you pull money out personally as a distribution, it comes out to you completely tax-free, but it would still be subject to that UBIT tax.
All right, Scott.
Do we have any other?
That is all the questions we have for now.
Okay.
People who are attending, if you got any more questions, please feel free to post them in the chat. But so far, I think you covered most of them, or all of them.
All right, good. Well, I'm glad to help and get that information out. I mean, I'll put my contact information up here again on this last slide. Again, we talked about a lot today. We kind of bounced around on some different topics, talked about different account types. So like I said, what I presented tonight is really just merely to get you thinking about what you can do with your funds and doing different types of alternative assets. But you're going to have your own unique questions when it comes to your particular account type or your particular investment strategy. And that's where I think calling me, emailing me, and getting kind of a one-on-one so we can address your individual concern is best. Oh, we had another question pop up. What if I use an HSA? Yes, you can use an HSA account to invest as well. You can do the self-directed accounts. We do any type of IRA. We can also self-direct an HSA into all of these same types of investments, and it follows the same rules that we talked about as well tonight for IRAs. So the same limits on investment options and different people that you can invest in, but you can certainly use an HSA to self-direct.
All right, I think that was all the questions.
Okay, good. Well, I hope everybody got something. Got, like I said, at least get your motors go. The gears moving inside your brain, and thinking about different ways you could take advantage of your retirement account and get it out of what's going on in the market as we stand here today, with what we've seen. And again, people always being either fearful of what might be coming in the future, and they can sleep a lot easier at night knowing that they have their money invested into a real estate investment that's kicking off kind of a consistent return. At least I'm sure that's what you see when you talk to people, what they're looking for.
Oh, absolutely. Absolutely. Well, thank you so much, Scott, for taking the time to go through this. I actually really like those case studies. That's how I'm a learner that way. So learning how different placements work and how you can leverage those case studies to understand how you can place your capital, that actually helped me a lot. I didn't know some of that stuff. I didn't even know. And I've been doing this for a little while now. So thanks for going through that. And if you could put your card information back up there, just in case somebody missed it, they joined a little later.
Yeah, I have it up right now. Is it not sharing?
Oh, there it is.
Oh, there you go. Yeah, there it is. Yep.
Awesome. So if you have any questions, you can reach out to Scott. You can also reach out to myself as well. We do still have some options available for investment here at Excite. So if you do have some questions, would like to go forward with Advanta, or just want to meet and see what your options are, feel free to reach out to myself or Scott here. You can use his QR code as well. And again, thank you so much, Scott, for going through this presentation with everyone. Oh,
Lisa, I appreciate you all inviting me on and allow me to share that information. Again, I hope that those on the call got something out of it. I'm glad you did as well, obviously, having done this for years. That's what we strive to do. Again, we just want to educate people and open your eyes to what else is possible out there.
Absolutely. Awesome. Well, thank you so much. And thank you, everybody, for joining. We'll let you get back to your evening. And again, reach out to myself or Scott anytime. All right, everyone, have a great evening.
Thanks, bye.